Hello, everyone, and welcome to Money Show's virtual event. Next up is Lynn Alden Schwartzer, an analyst with ElliottWaveTrader.net. Today, Lynn is going to present protecting wealth this decade. Then at the end, we'll take a few questions if we have time, if you want to type them in the box on the right side under Ask a Question tab. So Lynn, please take it away.
Hey, thanks for having me. So my name's Lynn Alden, and my background comes from a blend of engineering and finance. So I do fundamental analysis, both on individual companies and with a macro perspective. And I partner with Elliott Wave Trader for some of our services. So I provide fundamental analysis, and I work with some of their technical analysis. I don't personally do technical analysis. I focus on the fundamentals. So this presentation is going to take a brief look at some of the big trends to be aware of in this decade, because obviously it's a very challenging time for investing. And there are a couple, kind of historical contexts we can look at to figure out how to navigate this. So as a background, context, we are at the peak of what some people call a long-term debt cycle. So if you look back in history, so taking a step back, most people know what the short-term debt cycle is, right? So the business cycle plays out every 5 or 10 years. Households and companies lever up, and then they encounter some sort of shock. They have a recession, and then they end up having to deleverage. Often the government comes in and provides some sort of stimulus and increases their debt during the deleveraging event. And this cycle keeps repeating over and over again. But the thing is that debt never really gets back down to the level it was prior to that expansion, right? It keeps kind of inching up to a new high and a higher low in every one of those cycles. And historically, whenever there's 10 of those cycles or so, debt levels get to extraordinarily high levels. And that usually requires some sort of larger deleveraging event that normally includes a currency devaluation, right? Because the debt level itself is so big that they end up having to resort to more macro factors and currency devaluation to take care of it. So these charts show, the chart on the right is from Hoisington Capital Management. It shows the very long-term debt cycles play out every 50 years or more. And then the chart on the left just shows like the more recent version of what's happening now. And this is of quarter 1, so we're actually going to see a much higher debt to GDP level in quarter 2. And to put it into perspective, debt, if you include government debt, private debt in the United States, it's about 360% of GDP, which is near its historical peak. So of course the question is how do we navigate in this environment, right? Because bond yields are at record lows, stock valuations by many metrics are very high, and we have this very high level of debt in the system. So if you look back over the ultra long term again, this is a chart that was originally made by Bridgewater Associates, and I've been updating it this year because even though the original chart was from last year, this is actually a very good chart for this year. So with some updates and annotates, it's become more relevant. So if you look back over this really long term period, the last peak of the long term debt cycle happened in the 1930s. And what normally happens in that environment is that interest rates hit zero, right? So the monetary authorities kind of run out of room to lower interest rates anymore. So what they turn to instead is money printing. There's various ways they can call that. They can call it quantitative easing. There's all sorts of different words for it, but they essentially increase the amount of reserves in the system, and over time, this devalues currency, and they end up decreasing the debt as a percentage of GDP, by increasing the money and the GDP nominally rather than ever decreasing the debt. So this is kind of a macro event to look out for every several decades. So if you look back in during that period, of course, the 1930s had the Great Depression. They had a giant private debt bubble. And they started, deleveraging that. They had a significant currency devaluation relative to the gold peg. But then when they moved into the 1940s, right, they had World War II, and we had a federal debt bubble, and they had to do massive deficit spending, well over 20% of GDP, to win the war. And that created, debt to GDP got over 100%. They had these very high deficits, and that created a more inflationary environment. And then we, of course, had this very long-term interest rate cycle play out. We had more and more inflation. We had rising interest rates to deal with that inflation until, of course, we got to the early 1980s when we began this 40-year disinflationary trend with lower and lower interest rates. And then in the past 2 recessions, we started to run into the zero bound again. We started to get at the very high debt levels. So we resorted to the same policies as last time, which is money printing essentially. There's different flavors of money printing. So this is a similar chart. So the blue line is 10-year interest rates, 10-year treasury rates over the ultra long term. And the orange bars are the inflation adjusted returns that investors got over the next 10 years from investing in treasuries from that year, right? So if you invested treasuries in the 1920s, you did very well, right? If you invested by the late 1930s, that's when you started to run into problems, right? Because the 1940s were very inflationary and the 1970s were very inflationary. So people that bought and held treasuries for most of this, 30 or 40-year stretch after the previous long-term debt cycle did very poorly. And that's because treasury yields failed to keep up with inflation. And so if you were holding cash, if you were holding treasuries, any of these kind of very low yielding cash-like investments, very safe investments, they lost a lot of value on a real basis, even though of course you didn't lose money nominally, right? So treasuries didn't default. Banks after the crisis were well protected after that the big crash that happened in 1930s. Uh, they lost money then, but of course I'm saying in the decades that followed, you could hold cash, you could hold treasuries and do okay nominally, but you lost money on a real basis. And that's kind of becoming one of the challenges today, where we're back to record low interest rates, even lower interest rates than we had back then. And the way that they did this was, so if you look in the 1940s, the Federal Reserve used a policy called yield curve control, where they said we're going to lock interest rates at 2.5% or below, no matter what inflation does, right? So no matter what the market wants to price treasury bonds at, we're going to print money and buy bonds as needed to lock yields at 2.5% or below. So on the right chart there, we have the blue line shows the treasury yield over that decade, and the orange line shows inflation. So even as inflation had these big double-digit spikes throughout the that 10-year period, 10-year yields were locked very cleanly at 2.5% or below. And the chart on the left shows what happens then if you're holding treasuries throughout that period. So you made about 2.5% a year, so it compounded. By the end of the period, you made about a 27% cumulative return, but you lost about a third of your purchasing power on an inflation-adjusted basis because your returns failed to keep up with inflation, which is a very challenging environment for investors to deal with. So there's a couple ways to deal with this. Historically, when there's a currency devaluation, there's some type of assets that can hold up pretty well. So equities in some cases can hold up very well. Precious metals can hold up very well. Commodities can hold up very well. Appropriately priced real estate can hold up very well. So here's an example of the gold chart that I like to use. And there's a lot of things going on here, so I'll explain it. Over the long term, gold has certain variables that tend to move it more than other things, right? So of course, it trades a lot on sentiment and fear and things like that. But if you actually look at long-term history, it correlates pretty quantitatively with some metrics. So the price of gold tends to rise roughly as fast as the broad money supply per capita, right? So this chart, the blue line is the increasing money supply per capita, and the orange bars are the price of gold, and it's all normalized to 100 in 1973. So they start at the same number, and then we see how fast they grow relative to each other. And historically, if gold significantly outpaces the money supply, that's when you have to be more careful. So we saw this happen in 1980 and 2011. These are very big gold spikes, and the price rapidly outpaced the actual money supply creation. On the other hand, one of the best times to buy ever was the early 2000s, when gold severely, failed to keep up with the money supply growth, and that ended up setting the stage for an absolutely massive bull market over the next decade. Now, the gray line on the chart on the right axis shows real interest rates, which is the 10-year treasury yield minus the inflation rate. So a lot of those big spikes in the gold price tend to happen during periods of negative real interest rates. And the reason for that is pretty logical. So when you can invest in treasuries, like say you get paid 5% on your treasury yield, like back in the day, and inflation's 2%, that means you're getting a 3% real rate of return for holding those treasuries. So there's a very large opportunity cost if you instead hold gold, right, which pays you no yield and has a storage cost. And instead it just it's scarce, so it tends to keep up with inflation, but doesn't pay you to own it. So, however, when you have an environment where real yields are very low or even go negative, the opportunity cost for holding gold decreases, and then it can even turn positive, where it's better to have something that yields 0 than something that yields far lower than the inflation rate. And that's what we generally see. So over time, gold has a tendency to keep up with broad money supply growth rate. And along that trend, it can underperform or outperform that trend, largely based on what real interest rates are doing. So as you've seen recently in the chart, we have had a pretty good bull run in the price of gold, but this doesn't look anything like 2011, right? So in 2011, the gold price got way ahead of the broad money supply. Whereas now the money supply has grown dramatically and gold has simply kept pace with it. And real interest rates are very low. And as I showed from some of those yield curve examples, there's a good chance that in this environment with so much federal debt, yields are likely to stay very low for a very long period of time. So I already talked about the yield curve control they did. And if you look at Federal Reserve meeting minutes and some of their public presentations, they've talked about doing yield curve control again. So they began talking about it in 2019. And of course, with the very fast debt accumulation from this pandemic, they've rapidly increased their debt. And so they've once again began talking about yield curve control. And they even referenced the 1940s in their meeting minutes when they were discussing it. So in an environment where yields are kept low, inflation can fluctuate over time, right? So if you have a deflationary shock like we have at the moment, you can have low inflation, but when you have a recovery, you can have higher inflation. And if they keep yields very low through bond purchases and other means that they have, gold can do very well, especially as long as it doesn't really get far ahead of the money supply growth. So gold is a pretty good portfolio hedge in this environment, even though sometimes you can get periods of if it runs up pretty fast in a month, you can get kind of high sentiment, and you can get a sell-off and a correction because it gets overheated. However, I've been bullish on gold since 2018 for my subscribers, and I still think there's a pretty long runway ahead for this as part of a diversified portfolio. I think it's one of the ways that investors can protect themselves. And as an example, one way to think of the S&P 500 or other major stock indices is instead of thinking of them as being priced in dollars, you can think of them as being priced in gold, which, back in the day, the Dow Jones, a century ago, was priced in dollars and dollars were backed by gold. So when over time, of course, the dollar's been decoupled from gold. It's no longer pegged to it. So the dollar loses value compared to gold over time. So we have these charts over time that show, stock indices going up exponentially. However, if you go back and just say, let's keep it consistent. Let's just price major equities in gold and see how many ounces of gold does it take to buy, the S&P 500 or the Dow Jones or the NASDAQ, things like that. So this chart shows it reversed, right? So instead of the S&P 500 as priced in gold, this is basically flipped upside down. So it's the gold to S&P 500 ratio. When it's going up, it means gold's outperforming stocks. When it's going down, it means stocks outperforming gold. So of course, back in the dot-com bubble, lead up to that throughout the 90s, that was a very cheap period for gold, and it was a very expensive period for stocks. So stocks greatly outperformed gold going into the 2001, 2001 peak. Then stocks turned down and gold started its very long bull market. So for about a decade there, gold dramatically outperformed the S&P 500, and that peaked in 2011. And then, gold started to decrease, and the S&P 500, was pretty early on in this business cycle. So stocks did very well compared to gold. Now, back in 2018, GDP growth peaked, right? So even though 2019 had positive GDP growth, it was at a slower rate than 2018. 2018 was kind of the growthiest part of the cycle. And so the S&P 500, as priced in gold, reached a peak level in 2018. And since then, it's been making lower highs and lower lows, whereas this chart shows, since it's upside down, gold is making higher highs and higher lows compared to the S&P 500. And interestingly, in early this year, the gold to S&P 500 ratio broke above its 50-month moving average, as you can see on the chart with the blue line. So, my contention for a while now is that we're in a somewhat more structural bull market for precious metals, likely outperforming major equity indices for quite some time until we get to a stage where gold gets more expensive or stocks get much less expensive. This is a similar chart for silver. So it's the silver to S&P 500 ratio. Again, it's basically the upside down version of the S&P 500 as priced in silver. And so of course that followed a very similar pattern. and it's been bottoming out in 2018, 2019, and we've had a pretty significant breakout in silver relative to stocks in 2020. And so even though in the near term silver was quite heated, right? So sentiment in the sector is pretty high. It can have near-term overbought signals, right? So you have to be careful about taking on leverage or getting too excited too quickly. However, another way of looking at this is that this is a bottoming process that is now breaking out. So silver has potentially a long way to go when compared to outperforming equities, with silver being historically very cheap by many metrics and stocks being historically very expensive by many metrics. And this helps show things a little bit more fundamentally. So again, there's a lot going on in this chart, so I'll walk you through it. So many people are familiar with the CAPE ratio, which is the Shiller, Robert Shiller, his cyclically adjusted price to earnings ratio, which takes the, instead of just looking at the price to earnings of a stock over this year, it takes the last 10 years of inflation adjusted earnings and compares the current price to that kind of long-term, growth trend of earnings. And historically, the stock market tends to do pretty poorly whenever the CAPE ratio is high, and it tends to do well whenever the CAPE is low. So in other words, the whole old saying, like, buy when there's blood in the streets, right? So buy when there's bad news, when valuations are low, rather than buy when things are very expensive. So the blue line is the inverse CAPE ratio. So it's 1 divided by the CAPE ratio. Another way of thinking about it is it's the cyclically adjusted earnings yield of the S&P 500. So whenever that is high, that means that stocks are pretty cheap because you're getting a lot of earnings for your price of your shares. And whenever it's low, it means stocks are very expensive. You're getting very few earnings for your price of your shares. So that's the blue line. The orange lines are the forward 10-year annualized returns of the S&P 500, including reinvested dividends over the price of gold. So whenever those bars are positive, that's a period where if you had bought stocks instead of gold, you did very well. Stocks outperformed gold during those years. On the other hand, whenever those bars are low, it means that stocks underperformed gold over the next 10 years, and in some cases pretty dramatically. Sometimes they compounded at negative 10% a year for a decade compared to gold. So as this chart shows, historically, whenever the CAPE ratio, is very high, meaning that the blue line's low, or the earnings yield is low, stocks are expensive, historically they go on to underperform gold over the next 10 years. It's a pretty reliable historical pattern. Not always, but it usually holds. And if it doesn't hold, they usually only outperform by a small amount. And so this chart shows that to this day, stocks are quite expensive. And of course, gold doesn't go to the end of the chart because this needs data over the next 10 years to work. But if you look at it now, gold has been outperforming since 2018. And my contention is that there's a pretty good case that if you look back in 2028, 2029, 2030, stocks will likely have underperformed gold in these years. Of course, we won't know till the future, but there's a good fundamental case for it given all the evidence I've shown so far. A couple other trends we can look at, besides just holding precious metals in a portfolio. Of course, we want to have diversification. So I just want to highlight 2 example stocks here. So these are from FastGraphs, these charts. It's a company called FastGraphs, and they show stock price relative to fundamentals. So the blue line is what the stock price would be if it traded at its average PE ratio over time. And it includes both past data and includes forward analyst consensus expectations, Wall Street consensus. And so as you've seen, this is Cadence Design Systems. So they make software for engineers to design electrical circuits and computer systems, right? So it's a tech stock. They've been around for a while, so it's not a new company. They're profitable. But we've had an absolutely massive disconnect in recent years of their stock price compared to their fundamentals. So the fundamentals are doing fine, they're growing, they're doing very well. However, the stock price has absolutely soared to valuations not seen since the dot-com bubble. And this is a pattern I've seen a lot of growth stocks these days. The economy is so bad, they don't know what to buy, so they buy tech and growth stocks that are doing pretty well. But the unfortunate thing is that if they become overvalued, they start to get more risky, and that's what I believe we're seeing now. This is another example. It's Amgen. They're a large, bio company. They have a pretty diversified portfolio of different drugs. And this is an example that's different than Cadence because the stock price makes sense relative to the fundamentals and relative to forward analyst fundamentals. So they pay a growing dividend, unlike the previous one. They're at a much lower valuation, and they've actually grown faster than the other one over the past 20 years, although they've grown a little bit slower in recent years. So this is an example of a stock I would like to have in my portfolio, whereas the other one I'd be more careful about. So we've seen a record divide in recent years where growth has absolutely crushed value as an equity factor. And in some cases, that's warranted, right? So a lot of value stocks were over leveraged, they ran into problems. But there are a lot of quality companies out there that still have pretty good prices relative to their fundamentals. And it's impossible to say for any specific stock whether it would outperform another stock for sure, right? So there's a whole host of factors that can happen. You know, analysts can only estimate into the future with normal degrees of certainty. They can't know kind of curveballs that can happen. So there's no guarantees in investing. But what I would say is that I'd rather have a basket of stocks that look more like this chart than a basket of stocks that look like this previous chart, this cadence chart, right? So uh, I think investors have to be, kind of careful in this environment and really take a look at their portfolios to see, to find issues where their share prices may have totally decoupled from their fundamentals. Because it can feel really good while it happens, but the forward returns from that period over the long term tend to struggle when things get so overpriced. And lastly, it's a very controversial asset class, but Bitcoin is a pretty interesting speculative opportunity at this moment. So if you look, if you look at like a linear chart on Bitcoin, it looks like madness, right? It went nowhere for a long time, and then it had a big bubble in 2017, and then it's been in this big kind of choppy bear pattern. However, if you look at it in log form, there's actually a lot more rhyme and reason to Bitcoin's price chart over time. And so, of course, this is a cryptocurrency. It's the largest one. It's the first one. It was invented in 2009. And a thing to know about Bitcoin is that the new supply of it, the new supply that comes online every 10 minutes, it gets cut in half roughly every 4 years. So in the beginning, Bitcoin, there's only ever going to be 21 million Bitcoin. And in the very beginning, when it was launched, there were 50 new Bitcoin created every 10 minutes on average. And after 4 years, the algorithm cut that in half. So only 25 new Bitcoin were created every 10 minutes. And then it got cut in half again 4 years later, 12.5 per 10 minutes. And just this past May, it was cut in half again to 6.25 Bitcoins every 10 minutes are created. And out of the 21 million Bitcoins that will ever exist, 18.5 million of them have already been created. So we have kind of diminishing supply going forward. And there are all sorts of kind of questions on how to value this asset. It's a very challenging asset to value. But if you look at its price history, almost all the bullish action for Bitcoin happens in the first year to 2 years after the halving event, right? So the chart on the left there shows it kind of starts each one of those cycles at the halving event and shows how it performs relative to that price until the next halving. So we see a pretty clear pattern here. The first 2 years are always, historically very strong. This is a log chart, right? So the first one, of course, it went from a micro cap, it went from like worth nothing to worth over 20. So of course you had an almost infinite gain. The second run up, the second halving cycle, they still had 100-fold increase in the price. But of course, this was a very small asset class. So it's like a micro stock becoming a small cap stock in a way. And then, of course, the bubble that everybody knows about is the 2017 bubble. So Bitcoin had, about a 20-fold price increase from its previous peak during that halving cycle. And so after it reaches those feverish manias, it eventually cracks and then it enters this consolidation period. And eventually the halving event happens. And what happens is that if there's still consistent demand for the asset, but the new supply is decreased, the prices of the available coins tend to get bid up. I'm pretty bullish on Bitcoin as a speculative opportunity over the next, call it 12 to 24 months, or on average about, 16 or 18 months. I made a bullish call on this. I've been avoiding it for several years, and I made a bullish call in April of this year when it was just under 7,000. It has since increased to about 11,000, but I still think this has a very long runway ahead over the next year and a half. And it's not guaranteed, so you have to manage position sizes. But I find this to be a useful hedge in this very interesting environment because people are drawn to it. It's a scarce asset. It can move kind of between countries, and while all these governments and fiat currencies are printing very aggressively. So this is a kind of an interesting speculative hedge for people that kind of do research and are willing to kind of see how it goes over this particular halving cycle as part of a diversified portfolio. And I can stop there and take any questions if people have them.
Great, Lynn. That's a great presentation. Very interesting. Thank you for some great charts too. Let's take a couple questions. So Malcolm wants to know, where would you invest now if stocks are overvalued?
So a combination of things that I covered. So I still like precious metals for the long term. I like Bitcoin as a small position, as like a kind of a speculative hedge. And I like stocks like Amgen over stocks like Cadence, right? So stocks where the fundamentals have not totally, where the price has not totally decoupled from the fundamentals. So that's more in the value space, but not just value for its own sake, right? Not just cheap companies, right? Because a lot of them are struggling. It's about finding companies or types of companies, sectors where the fundamentals are still solid and the prices just haven't decoupled, from the price. And, with any individual stock, you never know what's going to happen. But if you kind of have a process and a consistent method for buying those types of stocks, it can do pretty well over time. So I do like high quality value stocks. I do like some international stocks. If they're high quality, they're relatively cheap compared to the S&P 500. And that's not always the case. So there are periods where international stocks are more expensive than the S&P 500. And right now we're in a kind of a place where we have among the widest valuation gap ever between US stocks and foreign stocks. So, and the same thing for growth stocks versus value stocks. So, I like equities on the value or international side of the spectrum, but again, with a quality filter, right? Not just buying cheap things for their own sake. So, for me, combination of decent equities, precious metals, I like Treasury inflation protected securities, so TIPS, and the Bitcoin hedge.
Great, Lynn. Thank you. And we have a question from John. He says, based on your analysis and forecasts for gold, do you have an upper target price for gold?
No specific price. I do think there's a good chance that in the 2020s we'll see it breach 3,000 or more. And there are upper targets that they could reach that I don't think are unreasonable in certain types of kind of scenarios that play out. But because this is a very unprecedented environment in some ways, we have to go back to literally the 1940s to see kind of macro conditions like we have now. And even then, it wasn't the same. It's always history repeats. History doesn't repeat, but it does rhyme, right? So I don't have a specific price target for gold, but I continue to track it with a variety of charts like this and a variety of kind of ways of measuring its value relative to different parts in history compared to other types of commodities. And at the moment, I consider it kind of fairly valued in comparison to many things that I think are overvalued. So I think it still has some pretty good upside.
Great. I think we have time for one more question. Michael wants to ask, is there any case where silver does not act like a more volatile relative of gold?
Oh, well, the thing with silver is that it's about half industrial demand and half monetary demand. Silver, there's jewelry for it, there's coins, and of course there's bars, and then there's the industrial side. Now, I think both halves of that are pretty attractive. So on the industrial side, it's used in a lot of electronics, it's used in solar panels. Most of the things we think about happening over the next 10 years involve a lot of silver. I also think that we could have a lot of investor demand for reasons I cited, right? So in a yieldless environment where sovereign bonds, you have to pay to own them, right? A lot of people would just rather have precious metals, and especially once we have a breakout, right? So silver can find a price floor here, hopefully, I think it'll always be more volatile than gold, right? Because it's a byproduct metal. It has multiple different demand sources. So it's always going to be more volatile than gold, most likely. But I do think that as part of a diversified portfolio, and when you buy it, kind of knowing why you're buying it, rather than worrying about week to week fluctuations, but buying it when it's cheap, as part of a portfolio, and then having kind of an understanding of why you own it, can give you pretty strong hands for being able to hold it through the volatility that tends to be associated with that metal.
Okay, Lynn, great. Thank you for a fantastic presentation.